Here's how a US government shutdown can affect the stock market and what historically happens. We have less than 2 days for a deal to be reached to avoid the shutdown. What I'm about to cover is not financial advice. I am holding on making any trades for today and tomorrow just to see how this plays out. If there is a pullback, I'll likely be buying more quantum stocks. If you want to discuss this in more detail, go join the free trading Discord. The link is in my bio. DM me if it doesn't work. It's free to join today. So first up is uncertainty, which markets hate. Even the threat of a shutdown can send stocks swinging intraday, volatility goes up, investors pull back, and risk premiums can rise. However, we're not seeing that too much today as the market is running positive. Second is missing data. Key reports like jobs, inflation, and GDP come from federal agencies. During a shutdown, those reports can be delayed. That means investors in the Fed are flying blind, relying on private estimates instead of hard data. Third, regulatory slowdowns. Agencies like the SEC might freeze IPO reviews or slow down M&A approvals. That can stall deals and lock up liquidity in certain sectors. And then fourth is government-dependent industries. Defense, infrastructure, energy, any sector tied to federal contracts can see revenue delayed. Cash flow interruptions hit those companies harder than most. And fifth is confidence in spending. Hundreds of thousands of federal workers can be furloughed or work without pay. Even if they eventually get back pay, in the meantime, they're spending less, and that drags on business confidence. Historically, shutdowns sound scary, but short ones haven't usually tanked the market. Stocks were actually positive about half the time during shutdowns and often higher 3 to 6 months later. On the day of the shutdown, the market usually reacted negative 0.4 to negative 0.6%. The longest shutdown caused a 2 to 3% pullback. The average return for a shutdown is 0 to 0.3% positive. So the real risk comes when they drag on for weeks or months. That's when consumer spending dips, contracts get frozen, and growth takes a hit and confidence starts to erode. So the bottom line, a short shutdown is probably just noise. Expect some volatility and then a rebound. Long shutdown, that's when it starts hitting the economy and corporate earnings in a real way. If you found this breakdown useful, hit tap and follow so you don't miss the next market explainer.